is Sonali, and I am from Finzene. At Finzene, we help people to plan for a better tomorrow by helping them attain financial independence by planning their financial investments without any biases to meet their needs. We offer our advice on right investments to help the investor grow their money and live their dreams. We provide professional support and handholding during the entire investment journey, and we are a team of financial experts with deep domain knowledge and understanding of the capital market. And today we have joined hands with CIEL, which is Center for Investment Education and Learning, for creating financial awareness among the college student on behalf of SEBI through the program FLY, which is Financial Literacy for You. And I will just pass it over to Jitin, who will give a quick round of introduction about our speaker of the day, Mr. Johnson. So Jitin, over to you.
Thank you, Sonali. Good evening, one and all present here. We, as a part of Finance Club in collaboration with Finzene Investment, presenting you the financial literacy program. So on behalf of Finance Club School of Management Studies, I welcome you all to the program. And it's my privilege to welcome the speaker of our today's session, Mr. Johnson Menezes. He has 25 years of experience in banking and finance and has worked in retail, corporate and SME and investment banking. And he has a 360 degree of exposure right from sales to collection. Academically, he has done his JAIIB and CAIIB from Indian Institute of Banking and Finance with an MBA in Finance from Jamnanal Bajaj Institute of Management Studies, Mumbai. And he has trained 4,000 plus candidates in BFSI areas, including assets, liabilities, credit, equity investing, capital markets, insurance, retail banking, mortgage finance, compliance and recovery or collection. He is associated as an adjunct professor with Thadumal Shahani Centre for Management, Mumbai, for training in BFSI domain, and has conducted programs for ICICI Bank, Axis Bank, Bajaj Alliance General Insurance, Tata Capital, Aadhar Home Finance Company, and TCS. He's also a subject matter expert for investor awareness programs and has conducted 25 plus sessions with 2,000 plus audiences since October 2021. So I'm welcome Mr. Johnson, sir, for entering the session, and I welcome all those who are gathering here. Thank you so much.
Thank you, Jitin. Thank you, Sonali. Am I audible? Everybody's voice is fine. Awesome. Great. So,
yes, sir.
Thank you, Jitin, and thank you, Sonali, for that introduction. But just to tell you is, keep all my experience, keep my qualifications aside. If I was your age and if somebody had given me this program, it would have changed my life drastically. Of course, it is changing, but then the earlier you start, you get that advantage of compounding. Anyway, that's what we will see. So without wasting much time, I'm just sharing my screen. Okay,
yes,
is my
sir.
Screen visible?
Yes, it's up.
Awesome. Thank you so much. Thank you so much. So yes, this is an investor awareness program for NIT CALICUT. It gives me an immense privilege and a pleasure to present this session before you. I've been told that audience is quite dynamic and quite curious about this program. So yes, definitely in terms of an interaction and your questions after that is what I would look forward to. So let's understand Indian securities market initially. Okay, so in banking, which is the watchdog? That is RBI. As far as food is concerned, which is the watchdog? Is it Food Safety Standards Authority of India, FSSAI? So similarly, when it comes to corporate listing companies on the markets, stock markets, SEBI is the watchdog. So what it does? So its primary function is protection, development, and to regulate the security markets. Ensure that there are no scams and always, be like a watchdog. Nobody is using any unethical practices. Major work is designing and regulation, efficiency and transparency, and newer products. So something which I have seen 20 years back and now it's totally different. So we've got that initiation of demat shares. When I sell my shares earlier, it used to take a lot of time for money to come in, but now that has totally been gone out, and fraudsters, scams, duplicate share certificates are all out of the picture. thanks to SEBI. Okay. Now, whenever you invest in security market, basically three things you need. One is a bank account, then is a demat account, and third is a trading account. Many of them, they club this together and they call it 3-in-1 account, 3-in-1 account. And of course, like any other account, you need a KYC. KYC may, there are 4 things required. One is your photograph, other is your PAN card, then is proof of address, which can be your passport, driving license, Aadhaar card, or electricity bill. Then is your proof of identity, something which says you are the same person, which again is an passport or Aadhaar card or a driving license or any government ID. So let's get deep dive into it. You can see the 10 richest people in the world. Okay. Of course, I'm sure you'll be knowing, but Jeff Bezos, so of course, Amazon, everybody knows. Microsoft is Bill Gates. Warren Buffett is the sole person who has made money only and only by way of investment. Bernard Arnault is of a company by the name of LVMH. Armiga Ortega. Anybody knows what is his line of business? At least the women out here should know it. You can put it in the chat box. Carlos Slim is into telecommunication business. Mark Zuckerberg, of course, Facebook and WhatsApp. Then you have Mr. Larry Page is Google. Sergey Brin is again a co-founder of Google. Larry Ellison is of Oracle. Just one question to you. And please mention that in the chat box. Who are the top 10? I won't say 10, top richest persons in India. You can just mention their names in the chat box. You can name them or you can name their businesses. That's absolutely fine. Come on, come on, come on. Top 10 richest in India. Now, these are all international in India. Okay, Jitin, fine. Adani, yes. Kesava, okay. Some more. Adani and Ambani, yes. Earlier, about a week back, Ambani was number 1, but with the listing of Wilmar Adani IPO, Adani has gone off. Lakshmi Mittal, yes, that's right. Jitin. Satish is saying Rakesh Jhunjhunwala, yes, he's the Indian Warren Buffett. Shiv Nadar, HCL Computers, Jitin, you're right. Some more names. Uday Kotak, yes, Kotak Group. George, you're right. Azim Premji, Wipro is good, but Azim is not among the top because he does a lot of donation. Okay, C. Poonawala of Serum Institute, yes, that's a very good answer. Palanji Mistry, okay. DMart owner, Siddharth, DMart owner is who? It's Damania, Radhakrishnan Damania. He is Rakesh Jhunjhunwala's guru, okay. Okay, the Birlas, George is saying Birlas, that's right. Birla, so when I go specifically, it's like Mr. Kumar Mangalam Birla's family. Ashirwad Palanji Mistry, okay, but he's not among the top 10. Yeah, he is rich. Mr. Satish is saying Damania. Damania is your Mr. Radhakrishnan Damania of DMart, that's right. Rega is saying Shiv Nadar of HCL Computers. Tata's is not among the richest, though he creates a lot of value for people, okay. He's got less shareholding. It's more into dividing his wealth, okay. That's the beauty about Tata. Okay, Kumar Mangalam Builder, that's right, Bharat. Akib is saying Anand Mahindra, okay. Jitin is saying Mr. Dilip Sanghvi, yeah, that's right, Sun Pharmaceuticals. Ramesh is saying S. Jindal and family. KM Shah, Harkishan, yeah, they are not among the top, but yes. Okay, Nilesh is saying, okay, Mark Zuckerberg's wealth has fallen down. Okay, Elon Musk isn't mentioned. Okay, fine. Adani is richer than, okay, fine, okay, yeah, fair enough. So I am comparing international and Indian separately, okay. Okay, Bharat is saying Rahul Bajaj, okay, point noted. Yes, we will go on and on, but let's move ahead. So I'm happy with that. So with this, one question which comes is, let me pop it on the screen. Ownership of their business, whoever rich people, I mean, the names which you mentioned, is it the ownership of their business or is it something else? Is it the ownership of the business? Okay, so just it's like if you want to be, you need to start a company like this. Is that what it is, or it's something else? And what is that something else? Okay, so I'll tell you. If you got to be rich, okay, and just let me know in your chat box. Okay, there is, if you got to become rich, employee may not necessarily, employment will not make you rich. Okay, that's a fact. You either have your own business or invest in somebody else's business. You either start your own business or invest in somebody else's business, or either do both. Okay, that doesn't matter. So if you see all of them where the real wealth has grown, of course they are promoters of a particular company, but they have also got shareholdings in various companies. So some of our colleagues mentioned about Rakesh Jhunjhunwala. Yes, Rakesh Jhunjhunwala is a pure investor. Warren Buffett is a pure investor. What he does, he takes money, he buys shares, waits for some time, shares appreciate, automatically his net worth appreciates. Okay, so that's the basically business model. Let's look at it something more on this. One question to you is, okay, now let's assuming you feel an oil refinery industry is going to grow. It's a booming industry. People will need oil for anything and everything, right? When you have your vehicles, you need oil. You just increase the price of oil and everything else starts shattering. Okay. What you have two options in front of you, which is easier. One is set up an oil refinery. Yes. The other is buy shares in an oil refinery company. Which is easier? Just put it in the chat box. Setting up or buying? Setting up or shares? Come on, put your answers in the chat box. I don't see. Okay. Ramesh is saying buy shares. Christopher is saying shares. Okay. Akil Iqbal is saying shares. George is saying shares. Great. Awesome. So there's no brainer. Okay. Jitin and Rega all are saying shares. So that's more easier. Fine. So what is the beauty about it is tomorrow, I mean, you take a stake, even if it's one share, you'll still be an owner. You can see movies, you can go out with your friends, you can do your studies, you can do your jobs, you can pursue your hobby. Unlike if you have a company, let's assuming as of now you have a company, all the time you'll be on the phone. Sir, labor problem. So, madam, there is this government notice which has come. Sir, there is again litigation again at a factory which is there in Delhi. Madam, what do? We are running short of the raw materials. Okay. So that's the challenge of a business owner. But then, yes, that's why we are saying it's easier for you to buy shares rather than setting up a business of your own. Now let's look at. Please mute yourself. Let's. Please mute yourself.
Jawahar, you need to mute yourself.
Okay, fine. I got it. Okay, so sorry about that. So let's take a chessboard. That's the company. Chessboard has got how many squares? 64 squares. So there are 64 shares, squares which represent, each one represents one share. Okay, fine. Now, assuming that one share is given to you at 1 rupee, over a period of time, the share price will grow. What are the reasons by which the share price would grow? Is basically increase in sales. As the sales of the business increase year on year, automatically the price of the share increases. So though you purchase it at 1 rupee, it may become 2 rupees, 3 rupees, 5 rupees. Company's reputation, that is goodwill or the brand, company's profit, correct? So that each one will keep on increasing. Fine. So that's the way it keeps on. That's the beauty about share increasing. Now let's look at it as time value of money. And why should we invest? The asset class and asset allocation. What do you mean by time value of money? We'll look at it with an example. A father has 3 daughters. Okay. Let's assuming daughter A, B, and C. All 3 are sisters. If you look at it as each one of them, he gives them 50,000 on their birthday. Okay. So the first daughter, whenever he gives her the first 9 years, between 20 to 28, that means 20, 21, 22, 23, 24, 25, 26, 27, 28. 9 years he gives each year 50,000, and that becomes 4,50,000, and she invests. Second sister, again same amount he gives, but from 28 to 36 years. Okay, fine. So that's 50, again 4,50,000. And yes, they invest it somewhere where the rate of interest is approximately 12% compounded CAGR, compounded every year. And the third sister, the same thing, but yes, only difference is from 20th birthday to 65th birthday. Okay, that amount is given to her, and that is about 19 lakhs. Now the question before you is, and I want you to put it in the chat box, right? And it's a lock-in period where they will get a chance to withdraw only when they are 65 years. Okay, fine. Who do you feel will make more money in terms of percentage of their investments? You can just put it in the chat box. So 50,000, 8 years, 20 to 20, the first daughter gets it. She puts it in some investment vehicle. Okay, it can be mutual fund through stocks, etc., directly stocks, or maybe bonds or promissory notes, whatever it is, right? The second one, from 28 to 36, again 9 years, again same amount, but yes, it starts after 9 years, and then till the age is 65 years. The third daughter gets an advantage. Now, whose money is higher? Who do you think? Approximately. You can call them first, second, and third, or A, B, C. So let's look at it, is what the system has got to say. Third sister saves 19 lakhs. Obviously, 50,000. She gets the advantage for a longer period. At 12%, it grows to 3.05 crores when she's 65. That's fine. Second sister and first sister both have saved 4.5 lakhs. Okay, 50 for 9 years, 4.5. But the second sister, it works out to 1.98 crores, whereas the first sister, it works out to 4.89 crores. From this, what do we learn? I mean, let's forget the third sister. Third sister is just 1 crore more, though she had an advantage of 19 lakhs. What does this data, or what does this illustration show? What do you get to learn from this illustration? Come on, Ashwarya, Ajit, Amina, Amjad, Anamika. I've not heard from you. Arvind, Arpit, Avinash, Azhar, Bhagya, Krishti, Soni, Durga. Come on. So here, the learning is simple. The earlier you invest, okay, the earlier you invest, your multiplies exponentially, correct? It's called the benefit of, you get an advantage of compounding. So though the third, let's look at the first sister. She got money, same amount as the second sister, but why did her money grow more than the second sister? Because it was there for a longer period. That longer period was 9 more years than the second sister. And let's look at the third sister. She invested more and more money compared to her other two sisters, 19 lakhs. But the difference between her and the other sister, in fact, first sister was much more than her, correct? So that gets to the concept about power of compounding. The earlier you start, the better it is. In fact, that's the message for you also over here in today's session. The earlier you start, the better. And don't wait till when you start working or when you're 25, 26, 27. No. The best time to invest is now, correct? If you see Warren Buffett, if you look at it, he started his first investment at the age of 11 years. And there are a lot of articles which say he making this statement and then confessing, okay, yes, 11 years, and I regret that I started late. So that applies to us also. The best time to invest is start immediately. So money grows exponentially over a period of time, and choosing the right asset and investing it for a long time, it builds your asset. So also the vehicle, okay, where you put your money. So we have taken a CAGR, compounding growth of 12%. If by chance somebody puts it in fixed deposits, where the rate of interest right now is somewhere about 6%, the rate may not have been that great. So time value formula is simple. Compounding. You know, the simple benefit is, I'll give an example of bank. Okay, two persons keep the same amount in the bank. First person, the money compounds every quarter. Every quarter means every three months. Second person, it compounds every month. And the third, it doesn't compound. So obviously, the second person wherein it compounds every month will have more than when the money compounds every month. Correct? So every quarter. So the more intervals for compounding, always that has got a benefit. No wonder Einstein said, your compounding interest is the eighth wonder of the world. Now let's come to your example. Very soon you'll start earning and you may get your first check. Fine. So let us see what are the rules, how you should go about investing, savings and investing. So whenever you get your money, what do? You save, then you spend, and whatever remains, you invest. I've been working in bank branches, and every time when I speak to customers, it's the same model everywhere. Okay. Where money comes in, you save the money, then you spend, and whatever remains, you go ahead and invest. But in 95% or 99% of the cases, by the time the money comes to invest, there is nothing left because expenses are so high. Right? So that's why you need to cultivate a habit wherein whenever money comes, first you will save, and not just save, go ahead and invest. And then whatever remains, you will spend. So that means there's a budget. So for example, if any season comes, instead of spending 10,000, you will not spend 10,000, you will spend about 2,000 or 3,000 because your budget says you need to spend only that much amount, right? It also talks about a 50-30-20 rule, wherein your savings and investments have to be 50% or more, and then your spending has to be 50% maximum, not more than that, and 30 and 20% has to be savings and investment. Now, when I say spending, doesn't mean you straight away spend. There are mandatory expenses. What do you mean by mandatory expenses? So, for example, I'm sitting here, I'm using electricity. So electricity is mandatory expenses. Rent is a mandatory expenses. You pay for the food, groceries, milk. Yes, that's a mandatory expenses. The rent of your house, that's a mandatory expenses. So yes, after you take care of this mandatory expenses, whatever remains, you have to not just save, but go ahead and invest. Why must you invest? So let's look at it as you would have heard about this monster. Okay. He's like a robber, not a proper robber, but somebody who eats into the value of your money. The money which you keep, say 1 lakh, slowly, steadily, the value of that 1 lakh keeps on getting less. And we call this inflation. In Hindi, we call it Mengai, correct? So automatically, you also would have assuming something which about 5 years back, your parents would have said, so much during my time, so it was so less. So much during my time, it was so less. So number one is inflation. Second is lifestyle. So take, for example, about 20 years back, about 30 years back, there was nothing called as a mobile phone at that point of time. It was a luxury. So now mobile phone has become a necessity, yeah. And person spending 20, 30, 40,000 is like, oh, that's absolutely fine. So this is the impact of inflation. So let's assuming if on an average, your daily household expenses is about 30,000. Okay. Let's look at the left part of my graph is 30,000. Next 5 years, that same amount of goods and services will cost you 40,000. Take another 5 years, 10 years from there, it will cost you 60,000. It will get doubled. And 20 years, it will become 80,000. Right? Take, for example, I remember about 10 years back, a cost of tea, okay, used to cost me about 2 rupees. Then it became 4 rupees. Then it became 5 rupees. Then 6, then 10. Now it is 12 rupees. Okay. Similarly, if you keep some money in your house, 1 lakh, what you could buy now for 1 lakh, next time, I mean, you would need to spend more for that. So again, an example of tea, I get the same glass, what I used to take it 20 years back, he used to give me full glass. Now he's giving me 80% after 5 years. After 15 years, he's giving me 50%. After that, 20%. After 20 years, he's giving me further less. Okay. So here also, if you've seen the size of tea, where you get tea, it keeps on reducing. Like many of you who would have traveled by trains would have experienced. Now, whenever you ask for a tea, it comes in such a small thing, like, in a one sip itself, it gets over. So that's where, inflation is increasing slowly and steadily. and that is eating into your wealth. The inflation rate is approximately about 6%, around 6 to 7%, fine. But yes, that is eating into your wealth. So that's where it is important for you to invest your money for two things. One is to beat inflation. Yes. Second is to beat taxation also, because you are earlier during your parents' time, there was not much of tax, but now wherever you put money, there is a taxation which comes into picture. Now let's look at asset classes. Assets are where you can deploy your money to invest. Now you understood that if you don't invest, fine, there is something called as the inflation which is going to kill you. So that's where you should invest in those avenues where you get return which are much more than the inflation rate. So which are the various options for you to invest? So you have a bank deposits. Yes. You have insurance, property, mutual fund, gold, stocks, and bonds. Now, these are different asset classes where you can invest your money depending on what is your risk appetite and what is your time horizon. So let's look at equity. Equity is basically shares. There are two exchanges where you can go and buy equities. One is Bombay Stock Exchange, the oldest one, and then you have a National Stock Exchange. Equities over a period of time, any newspaper, if you go, it's got a good track record. It's considered to be giving you one of the highest returns vis-a-vis the other asset classes. So now somebody may say, see, sir, there is gold, there is property. Now let's look at property vis-a-vis equities. Properties will take some time for it to appreciate. There is a risk also. Number one. Number two is, unlike shares, you can take multiple companies. Okay, you've got experts to advise you. Properties, you cannot take multiple properties. Okay, fine. It would be very rare where you can take 5 or 10 properties, right? Third thing is, let's assuming I want 1 lakh rupees. I want to buy an Activa which is costing about 85-90,000. Okay, so equities, I can sell a few shares and I can get that money. But in a property, is that possible for you to just send your gallery and get that 1 lakh and take that Activa? It's not possible. And even if you do, the value of the overall asset will further go down, because then you'll have to sell your property without any gallery. Now there are these fixed income sources also. So now equities comes with risk. It's like any business. But fixed income, the returns are less, but the risk is also less. So I remember there is this Sharma ji who's in my neighborhood who retired last year in March 2021. Now he's got a corpus. You know, when you retire, you get provident fund, you get gratuity, you get leave encashment, and whatever monies which are lying, you get all that. So he took this money and he doesn't want to take a risk, because this money is only the means of his income going forward, whereas his salary has stopped. So he would put in something like a fixed income securities, like a PPF, or something where he can get about decent returns. Now, these are the avenues where you can get regular returns. A debt fund is what we can call it. Debt is loans. So here, if you can see, there is a interest rate and there is a post-tax returns. So post-tax returns everywhere, if you see, if you look at inflation rate somewhere 6 to 7%, they are just, of course, they are less. Many of them are less than the inflation, or just able to beat the inflation post-tax. So that means if you are break even, you need to think of other avenues where you can make much more than the inflation amount. So that's where we introduce you to mutual funds. So just one thing I want to ask you is, which I asked in the earlier sessions also. Suppose a very close friend of yours, whenever he climbs any stairs or whenever he does some brisk exercise like running or something, he starts getting some sort of a pain in his chest, right? Now, in such circumstances, okay, you have two options. One is you tell him, oh, pain in the chest, don't worry, just go to Google. Google has got all the answers. Just go and you'll get the answers. Or the second option is, please go and visit either a family physician or a cardiologist, okay, and take his opinion. Now, out of the two, which one will you suggest and why? You can just put it in the chat box. Two options is what you'll suggest. Of course, everything is available on Google. So yes, go to Google, just put chest pain, what do you do? And then you'll get everything. Or else you'll recommend him to go to a doctor. And mind you, he is a very close friend of yours. First or second option. Either you'll tell him to go to Google. Okay, Jitin, thank you for the answer. What about others? Okay, Rekha. Krishna Kumar, Krishna Prakash, Aaron, Avinash, second option. Christopher, fine. Great, great. So why second option? Because a doctor is an expert, correct? A doctor, if the doctor says take this medicine twice a day, take this medicine 3 times a day, do this test, do that test, don't eat this, don't eat that. Without anything, you will follow that because a doctor is an expert, number one. Number two is he's got all those qualifications. And the third one is he's got practical experiences, right? A lot of people come, doctor gives them a prescription, they get better, and that's where you will go to a doctor. Most important, he is an expert. Similar, if you look at mutual fund, is there are about 5,000 companies which are there on the stock exchanges in the market where you can invest. Fine. And we learned two things in the start of the session. If you want to become rich, either you start your own business, which is good, and or you can also start investing in somebody else's business, right? You saw the example of oil refinery, fine. Similarly, now you do not know what are the options available. Somebody says, hey, yeah, during COVID time, everything was closed, but pharma did very well. Hey, Indian IT industry is going to be a boom. Superb. Just put money in that. Oh, electric vehicles are coming. Put in those stocks. That's really very good. So a lot of people will keep on telling you a lot of these things, but then how to choose that? Because finally, whose money is that? It's your money and you're going to take the risk, right? So that's where a mutual fund comes into the picture. So how a mutual fund works? You've got a group of investors like you, me, across pan India, fine, internationally also. Indians like and Indian citizens, NREs can also invest. They put some money, which they pool their money. So suppose if I can pay 500 rupees month, I will do that. If Satish can say I will put 5,000 rupees every month, great. If Jitin will say I'll put 1,000 rupees every month, that's great. This money is pooled and given to a fund manager who is a part of mutual fund. He then puts it into stocks or securities depending on what the mandate is. Now, for young guys like you and me, where we can take a risk, we would tell the fund manager we want equities or a mixed, correct, balance fund or a hybrid fund. But Sharmaji next to me who has retired, he will say, no, I don't want to take any risk. I want my money to be there. So either go in for a balanced one or go in for securities one, right? The returns are generated and they are delivered to you. Here, you have an option whether you want to retain them or whether you want to have them in your account, or you want to retain them there only where it gets reinvested and reinvested and reinvested. Okay. The compounding benefit, like you saw the examples of those three sisters. Yes, it's a compounding benefit which you want. So that's what a mutual fund does as per your instructions, as per your mandate. So there is a net asset value. So mutual fund, the various advantages are, first of all, it comes under SEBI. We saw a regulator is SEBI. SEBI is like a watchdog. So mutual fund has to comply with all those conditions. You and I, we cannot one fine day start together and start a mutual fund. There are a lot of strict conditions. That's why you don't have any normal companies, but you have big sponsor companies having mutual funds, which are banks and financial institutions which have got their mutual funds. Okay. Then you have a NAV where they put in basket of securities. Okay. It's not one stock, but it's a basket of stock where they get the benefit of diversification. Fine. So take, for example, one stock is not doing good, the other is doing fine, the other is doing better, then overall the market or overall the value increases. That's where they use the method of diversification. If you and I have to invest on our own, well, we'll have limited money, so we cannot diversify against 5 or 10 or 15 or 20 companies, which a mutual fund does, right? And then based on the value, there is something called as a NAV calculated, net asset value. What is net asset value is value of all the asset minus expenses divided by the shares. So if one share is costing 100, the other is costing 200, the third one is costing 250, they'll find out the total value of the entire portfolio divided by number of units, and that would be the NAV. So as this value increases, your NAV increases. If this value comes down, your NAV goes down. So various types of schemes which are there in mutual funds. So you have an equity scheme, then you have a debt scheme. Equities is where purely about 80% of that they invest in stock markets in various businesses of various companies. So you have fund manager who's an expert. His job is only to monitor the stock market every day, right from morning to night. He only monitors that. He He also finds out if there's an election in US, how it will affect the stocks. China is having some import-export policy, which companies it will benefit. Saudi is going to stop the oil or is going to drill more oil. Then it will again, which companies it will affect. It takes into account all those, and they take their decisions of investing in various companies. If they feel this company may not do fine, there is a better opportunity, they will withdraw from this company and put it in another company. They do it on your behalf, and that's why the capacity in which they operate is a trust. So it is on your behalf, they are taking all the decisions. There's a debt scheme which a lot of companies require loans from time to time, like a like a Tata or a Birla or a Reliance or a banks. They may need some money for 30 days, 60 days or 90 days period, or manufacturing companies. They may not go to the bank. They may come to public and ask for them. So that's where mutual fund invest in them. And there the money, the chances of risk, it's there, but risk is substantially less. Then there are solution oriented scheme. For example, I want to save for my kids education, okay, or for my daughter's marriage. So yes, there are those schemes, retirement schemes, children education schemes, etc. This is the equity mutual funds, okay. They invest in listed companies, which are in listed companies. So you would have heard about large cap, mid cap, small cap. So basically the first top 100 companies, okay, is called as large cap companies. Next, up to 250 companies are called as mid cap, and next is small caps. So large caps, mota moti, the market cap is about 20,000 crore plus. Mid cap is somewhere between 5,000 to 20,000, and small caps are less than that. Each mutual fund has got a mandate in terms of, so they tell you first, yes, this scheme is going to invest in large cap, this scheme is going to invest in mid cap, or this scheme is going to have a mix of small cap or large cap, or large cap and debt schemes, right? That's a mandate where they do it. Then is your debt scheme. Debt scheme is, again, I told you, people who don't want to take risk. So most particularly, these schemes are recommended for senior citizens or retired people. So GILT is Government of India Limited. Those funds where government also borrows, so they invest in only those schemes where they give borrowings, they give money to government companies. Liquid funds, there is an example, ultra short term, 3 to 6 months, and banking and POC funds. Okay. Again, there are active and passive funds. So what is active funds? Where suppose if I'm the fund manager, if I feel this stock is not doing good or this sector is not going good, I may withdraw, I may put it to some other sector, and so on. What do you mean by passive funds? They follow a market index. So there are two major indexes. One is BSE Sensex and the other is NSE Nifty. Nifty is an index of 50 stocks. BSE is an index of 30 stocks. So they will invest their money in these 30 stocks in the same proportion the way market is, right? Same thing, for example, in Nifty, in the 50 stocks, same proportion the way NSE has built in a combination. Now, we all say, market is going up, market is going down. And a lot of, means whenever we say the economy, right now it's somewhere between 2 to 3 trillion, and we expect it to become 5 trillion, fine? From 5 trillion to 25 trillion, definitely it will go that way. So automatically the corporates will increase. So this index, so take for example, the BSE is somewhere about 60,000, 58,000, 59,000. Okay, that index will slowly rise. So if you've invested in index fund, as this 58,000 increases, your money also will increase in same proportion. So if the index goes by 10%, your money will also increase by 10%. So this is an example of BSE. BSE has got 30 stocks. So that's called as Sensex sensitive index. So these 30 stocks, as you can see, they are a diverse. So it's like a sample of the entire economy. And these stocks have been taken across sector. It's not only say banking, it's not only say metals, it's not only IT, but a mix. So as you can see on my screen, there are these 30 stocks. So whenever you invest in an index, okay, even if it's 500, your 500 gets invested in all these 30 companies. And whatever, if they grow and if they fall down, your amount will increase or decrease in the same proportion, more or less. And if you see in the index, there are these 30 companies. There is a representation of financial services, metals, energy, telecom, consumer goods, etc., etc. So all the sectors are represented. So there could be a time, there could be a time wherein, take for example, software, a telecommunic IT is there, information technology. Let's assuming the dollar becomes weaker or the rupee becomes stronger, then these IT companies will suffer. Nothing to do with your business, but then they are all into export oriented. So if the rupee gets stronger, the realization what they get is comparatively lesser, which may affect them. But at the same timing, the other companies which are into export oriented, they will stand to gain. Sorry, which are into import oriented, they have an advantage, or the ones who are locally focused will have an advantage. This is the index fund. So similarly, BSE Sensex has got 30, Nifty has got 50. So far, do you have any questions? You can just put it in the chat box. We are giving you the entire holistic approach of the entire part of investing. Now, we will come to pension. Pension is where, of course, we need to ensure that money is there for our retirement age also. Slowly, steadily, the life expectancy for a normal male, which was somewhere about 64, 65 some years back, has now moved on to 68 to 70 years. Okay, so we will live longer period post our retirement. So it will become more challenging because in those years our expenses are higher, plus our income is zero. But so far, any questions so far in terms of, however, towards the end also we can take questions. But let me complete with pension funds, then we can go with the question funds. Okay, national pension scheme. So the government has felt the need that, we need to invest for our future. One of the major expenses which we will have going forward is your medical expenses, and which, if anyone from your family has got hospitalized, you would have seen the expenses are quite a lot. Okay, so one major expenses or one heart surgery, open heart, or if you want to put a stent or an angioplasty, what it's going to cost now, what it was 5 years back, now and next 5 years, the cost is increasing exponentially. That's why you need to have some pension fund which will take care of you when you are retired. So you start planning from now. It is open for all the employees from public, private, and even unorganized sector. So there are two types of accounts, tier 1 and tier 2. Tier 1 is default, where your money, okay, people who are working, for example, teachers or bankers, their money gets invested into selected 3 mutual fund companies where they invest on your behalf. Tier 2 is where you can choose whatever you want to whichever companies you want. So there are about 10 companies which are there, 10 mutual fund houses which are there, where you can put your money, and then that's the way they will put it on your behalf. And after you attain the age of say 60 or 62 years, then that corpus which is there, from that they will start paying you, which becomes a pension for you. These are the asset classes where they invest your money. So equity and related instruments, corporate debt, which is something like a debt scheme, government bonds. So equities ka exposure, they are having less exposure, wherein it's a tier 1 scheme because they don't want to take a risk as far as your capital is concerned. However, you want to invest, then you can go into tier 2 schemes where you can choose any mutual fund houses and you can invest. So that's where the first one talks about 3 companies wherein the government, whenever it takes money from you, for example, teachers or government offices, they will invest only, they will give you the choice to invest in either of these 3 companies, that is LIC, SBI or UTI. Fine. But yes, if you want some other company, that is up to you to start investing your own money there. These are the returns so far. These returns are calculated over the past 3 years. So NPS gives you about 8 to 10% because it invests in defensive sectors. It does not take a higher exposure to equity. ELSS, yes, equity linked salary savings, that is a good instrument for you to invest to get tax benefits as well as get an exposure to investing in equities. PPF, the rate of interest is not 8%, it has gone down, but yes, it's a guaranteed. So tomorrow, even if there's a World War III, World War IV, World War V, you will get that money. That's not a challenge. Same thing with regards to fixed deposits also. Fixed deposits, the maximum rate of interest right now is 6%, 6.5%. Again, these are risk-free because even the bank closes up to an amount of 5 lakhs is what you're insured for. This is the gold, the way you can purchase gold. And you can purchase gold directly from a jeweler or through a gold exchange traded fund. That is again a part of mutual fund scheme, wherein you can take an exposure to gold and you don't have a tension of buying a gold, keeping it, making charges, breaking charges. You can sell it in units also. Asset allocation. So asset is your money. You will, one way is you try to distribute it as many assets as possible. So like you have a thali whenever you eat. So there is a starter, there is a dry item, there is a main course. After that, there is a sweet item. So like a thali, similarly, your asset allocation has to be in different portfolios. So you should not focus only on, say, equities, only on bank FDs. No, have little bit of everything depending on what your goals are, right? So here is some samples are given is your trading. Then there is stocks. Then there is funds. Then there is real estate. Then there's gold. Then there's bonds. It could be also bank accounts, savings account, fixed deposits, post office schemes, PPFs, etc., etc. Now, one question which I want to ask you is, and please answer this in the chat box. If I give you, or I'm asking you, take this 1 liter of milk, how long will it take for you to make it hot? Please answer in the chat box. 1 liter of milk is what I'm giving you. How long will it take for you to make the milk hot? Please answer in the chat box. Come on, 1 liter of milk, how long it will take? Don't go to boil the milk, please. I just want the answer. Okay, Christopher, fine. I want to hear from others. Okay, Regu, thank you. Satish, you can assume whatever you want. Sudhanshu is saying 5 minutes. Jitin is saying 2 to 3 minutes. Ashirwad is saying 7 to 8 minutes. Come on, we've got a 60, we've got a clan of 60. You adjust intensity. Krishna, Prakash, you adjust intensity as per what you normally do, okay? Jawar is saying is 5 to 7 minutes on high heat. Aaron is saying 5. It can range from 5 to, depending on what you use to boil it. Okay, what vehicle, what vessel. Okay, fine. It can range from 2 to 5 minutes. Okay, Rega. Point noted. Come on, what about others? I hope they have not gone to boil milk. Nilesh is saying 10 minutes. Okay. Come on, what about others? I think never, others have never seen or never boiled milk. So let me give you the answer. Sir, madam, your answers are right, but the question is, you should first ask me, sir, you want us to make the milk hot, but why? What is the reason? Correct? What is your goal? Sangeeta, thank you so much. What is your goal? In the sense, if I want to make the milk hot, just to put it in the tea, I can just quickly do it for a few seconds and do it. Okay, fine. If I want to keep the milk overnight, heat it, cool it down, put it in my fridge so that I can use next day, then some of the answers what you've given is perfectly right. If I want to make some nice kheer, okay, at least half an hour I would need to make it hot, right? And if I want to make some rabdi, 1 hour is what I will need to keep it on the gas. Correct? So the question is, what is your goal? That is very important. Similar thing I want to ask you is, now you are doing this course. What is your goal? What is your goal in doing this course? You can just put it in the chat box, please. What is your goal when you're doing this course? Come on. Of course, you will never do this course. This course in the sense, your study is what you're doing. Okay, Christopher saying job. Okay, appreciated that answer. What about others? Of course, there has to be some objective, please. Think like an investor. Okay. No, Jitin, when I'm talking about this course is not what we are doing today, but your studies, your academic course which you're doing. Okay. A best career in management field. Okay, Jawar, fine. Good. Let me hear from others. Upgrading education qualifications, Rekha, that's a good answer. Hear from others. Come on. So let me give you some of the answers which I get from various types of. One is yes, a best career. Okay, upgrading your skills. Then some of you may would like to start a business. Yeah, that's why you're doing this course. So you have the knowledge which you can apply, knowledge and skills. Some of you may want to get a job, as one of the friends said. Yes, get into a job, and later on you can think about a career. Yes. Another some of the other advantages, since you are all studying together, you all are able to get a network form. Okay, fine. So going forward, this network can of course be your it can help you to increase your net worth, right? So again, Avinash is saying soft skills and networking. Yes, that's what Avinash is saying rightly, is networking among like-minded friends. So tomorrow, maybe 5 years hence, you all might be in different parts of the country, but still you can always speak and connect. Hey, I need help on this. Oh, I'm starting this new business. What do I do? Hey, I've got into something new like this. Come on, let's work together. Let's be partners and let's take it forward. Correct? So these are various goals. Similarly, let's come to our investment. Whenever you invest, what is your goal? Okay, so there could be short-term goals, there could be long-term goals. Short-term goals like something which is 2 years, 3 years is like I want to buy a nice Activa, or I want to buy a four-wheeler in the next 2 years time, or I want to take I want to take a holiday, or I want to visit my I want to go for a holy trip, fine, to the Holy Land or to some Tirtha Yatra. This could be a small term goals, okay? Or even you want to purchase, you want to construct or do house repairs or painting of your house. It could be a short term goal. Long term goal, I'll give you my example. I've got two kids. So I know now he's 10 years old. When he becomes 20 years old, he may do management, he may do technology, he may do pharmacy, he may do anything, but it's going to cost me a bomb. So yes, next 10 years, I need to save some corpus for his higher education. I have a daughter. Yes, when the wedding comes, okay, I need to have some money for that. Yes, I want to plan for my retirement. Now, so I get salary. Yes, but maybe once I'm 58, no salary, but then my eating will continue. So then I need to save for my retirement fund, something like that. Yes, or else it can also mean ki if I once I die or something, I want to leave a nice legacy for my kids. So these are various time horizons and your goals. Now, depend on this is where you will choose an investment accordingly. So, take for example, you want something in 1 year's time. Okay, if you want something in 1 year's time, you will not choose something in equity, because equity is quite prone to ups and downs, right? So you will keep it in the debt fund, right? So that's the way you go about it. Now, what is your risk appetite? At your young age, you can invest in stocks. I'm sure many of you would have taken an exposure to cryptocurrency also, which is quite risky. Okay, fine, but that's your risk appetite. That's absolutely fine, right? But I gave you an example of Sharma ji, who's my neighbor. He's 60 years old. He cannot invest in stocks, or he cannot see the market going up and down. I mean, his heartbeats may automatically increase or decrease when the market falls. So he is going in by way of a balance scheme or a debt scheme, right? So this could be various types of goals. Accordingly, you'll choose an investment. Mutual funds is all about planning. So it gives you various investments, wherein investments and schemes wherein you can put in, considering your objective, considering your time horizon, and considering your risk appetite. However, there are about 42 to 45 mutual fund companies, like for example, HDFC Mutual Fund, Axis Mutual Fund, ICICI Mutual Fund, Shri Ram, Sundaram. I mean, you name it, there are about 42. Each one has got approximately about 40 schemes. Okay. So that means you are spoiled for choices with some 2000 schemes. Correct? So in this, normally it is always advisable, if you're a first timer, to take help of an advisor who will sit and make a plan based on your investment objectives. He may choose an investment vehicle or a mutual fund scheme, that also with in terms of your risk meter, and then he will help you to invest. So I still do a lot of reading, I still do a lot of investing, but still I consult Finzene for a lot of things wherein I have a challenge, and based on my goal setting is what we had decided, these are the schemes which we do it. Okay, so Finzene is what I normally deal with from time to time. So let's move ahead. Yes, these depending on your time horizon. So there are some which grow in value and there are some which generate income. So what are the ones which grow in value? So property, yes, you may buy a property for 50 lakhs, 40 lakhs, 60 lakhs, 80 lakhs. That may not appreciate fast, but that is something which will grow. It may not give you regular income. Rental incomes are there, but rental incomes are, I mean, the yield is just about 2% to 3%, which is fine. A gold may not give you regular income, but yes, it can increase in value. Tomorrow you can sell it and make some money. Art, also some of them, they invest in art and equity shares. Similarly, what is it which gives you income on a regular basis? Bonds. Then you have a public provident fund which gives you interest every year. Then you have a bank and company deposits. In fact, the beauty about bank and company fixed deposit is every quarterly or every monthly you want interest, then they will give you that scheme also wherein every monthly or quarterly interest gets credited to your account. From there, you can withdraw and use it for your day-to-day spending. And there are debt mutual funds also, which gives you money on a regular basis. So here you see mutual funds is the only way where they've got a product for whatever needs. If you want a value, yes, they've got schemes for that. If you want generate income, they've got schemes for that. If you want a combination of both, so which is called as balanced or hybrid, they've got schemes for those. So the question before you is, are you investing in the right assets? Because keep one thing in mind is your objective of investment should be your goals, definitely, but also it should give you more than what inflation is about. Okay, so because thereafter you'll able to cover your inflation and keep some good money for your future. So these are the various types of investment pyramid. Just have a look at it. So the base is protection, which is not investment. Protection is insurance, where in case worst case goes, it's a risk mitigant. Then you have a regular savings, where like a savings account, emergency funds you may have. Then you have a growth and diversification. Then of course there are speculations, which of course we should avoid. And then is your wealth distribution. So let's look at the risk associated with various types of assets. So that's where we look at it is, what is your risk appetite? Okay. So in a class over here of some 60 plus friends, some may say, Chalo, I will invest in, I don't mind taking a risk because I live with my parents and I don't have major expenses. I can invest for a long time. Okay. There are some who would say, no, no, no. Like the ones who are senior citizen, no, no, no. This is only my corpus. If it goes away, then I do not know what to do. So I will try to protect it. Even if I get little bit more interest than this, that's fine. But I want to sleep very peacefully when I go to bed in the night, right? I cannot handle the ups and downs of a stock market, or I cannot handle the ups and downs of anything which is volatile, right? So a fixed income will give you an income like a 1 1 1 1 2 2 2 2 over a period of say 10 years. Fine. Mutual funds may appreciate. The way mutual funds will appreciate is slowly, steadily, they will keep on increasing as time goes by. You saw the power of compounding. That's what will happen. Equities, yes, again, the returns are high, but then the volatility is very high. Can you bear that risk appetite? That's a question which I would like to put it to you. But in the long run, because anyway, when you're investing in equities, it has to be for a long run. Long run, equities are considered to give you much better rate of returns than other asset classes. Of course, there are certain risks associated with equities investing also. And that's where we suggest that you go to an expert who can guide you. Mutual fund is an expert which can, there are experts who take your money and they diversify. You can see the track record. If you're not happy with a mutual fund scheme, you can withdraw the money and put it in some other scheme. Okay. So the risk which you should be aware about is the cash flow risk. The money may not come in. Then the default risk. So your money is given to some other company who defaults. So that's a default risk. Interest rate risk, normally that comes into picture wherein companies which are into import export, okay, where they sorry, that's a foreign exchange risk. Interest rate risk is where the interest rates keeps on fluctuating. Then credit rating risk, money is given to a corporate, that corporate defaults, your money, there's a big question mark. Asset risk, wherein it's like a bank gives you money against a property and the person bank is not able to sell the property. That's the asset risk. So these are the most common risks which are associated with the debt obligation. This is a beautiful thing, riskometer, which is there in, if you look at mutual funds or any investment, this riskometer is there. Now it talks about what is your risk appetite. Now, if I look at over here, some of you may take high risk. Okay, that's absolutely fine. Some of you may say, no, I'll take medium risk. Some of you may say, no, I won't take much risk. I want to have my money protected. If I get less returns, I am very happy with that. So this is risk meter, which is different for different persons, right? Every mutual fund or every investment scheme will have this. So tomorrow, let's look at it as if the risk is very, very high, then possibly I will feel a person who's got higher risk, he may go and invest. A person who doesn't have that risk capability, he will not invest. But keep in mind, higher risk, higher returns, and the person should know ki yes, these are the risk involved, that possibly I may make my money appreciate much higher, or there's a possibility of losing the capital also. Sip, this is something beautiful. Okay. So habits is what we always talk about. Habits. So what is the meaning of habit? Is something which you do unconsciously. So in the morning when we get up, we brush our teeth. Okay, that's because of a habit. So I don't have to use my mind and say, okay, now left, now right, go up, go down. No. Somebody who is riding a bike, a gear like a bike or a car, the gears, first gear, second gear, third gear, now it's become a habit. You are not consciously doing, okay, now first, now second, now third. It's become a habit. Similarly, mutual funds or any investment should be a habit. So whenever you get your income by way of salary, this money has to go. So SIP, systematic investment plan, is one such way wherein you have a disciplined approach and you automate it. What do you mean by automate? Is you tell the mutual fund, these are the forms every month. My salary comes on the 5th. So every month on 10th, please take a sum of rupees so and so, auto debit to this and invest in mutual funds. So you're earning money every month is going there. You're developing a system, automating the way you're doing your investments. Now, this can be done monthly, quarterly. It's similar to like a bank recurring deposits. The benefits of SIP, just by putting 500 rupees, you get an exposure to the entire mutual fund has invested in some 15 or 20 best stocks. You get an exposure to that just by a mere of 500 rupees. It gets in the discipline, what we talk about habit, and rupee cost averaging. That means when the market is up, you tend to invest less. When the market is down, you tend to invest more by buying more units. Power of compounding, which we've learned, is very important. Eighth wonder of the world, that's what Einstein says. You saw the story of three sisters. The one who started investing earlier made the most money than her other two sisters. Then no need to time the market. Okay, just put it. So tomorrow, if you say, "Hey, market has crashed," "Hey, market has risen," "market has crashed," you don't have to worry. Automatically, rupee cost averaging takes care of that. In fact, it works to your advantage and it helps in achieving your goals. So you can keep a fund based on your requirement or based on your scheme. Now let's look at two examples and I would like you to read and answer them. Okay, there are two friends exactly like you. At the age of 20, Ram starts investing 5,000 at the age of 20 and he says till the age 30. That means he saves for 10 years and then he stops. Let's see how much money he's got. Sham also same thing. Sham also is like a friend of Ram. They work in the same company. But what Sham says is, Bhaiya, I've struggled whole my life. I used to borrow money from my parents. Now 10 years I want to enjoy. After 10 years is what I will start investing. Okay. So Sham invests at the age of 30. And he says, what he says, okay, Ram did 5,000. Now I want to defeat him. I'll put double the money and I'll put it for a longer period. Okay. My retirement is 60 years. So 10,000 for 60 years, he invests till retirement. Now, at the age of retirement, can you tell me who makes more money, Ram or Sham? Please put it in the chat box. Okay, in the chat box, I can see my colleague Sonali has put a feedback link also. Please click on that and put in your feedback. It would be good for us to know these things, know your feedback from you. Yes, the question is who makes more money, Ram or Sham, according to you? Estimate, guesstimate, that's absolutely fine. Okay, what's the answer? Okay, Christopher. I'm waiting for others. Come on, my friends. Ram and Sham. Okay, Rega is saying Ram. I do not know. I may have to just go to the next slide where I'll know who's done better, who's done not. Come on, just one more minute. I'm giving you who's done good, Ram or Sham. Take a call. Okay, Jawar, thank you. Noel, thank you. Okay, Jennifer, thank you. Vishal, thank you. Iqbal, thank you. Let's see. Oh, sorry. That is so. So Ram's retirement corpus is 10.79 crores and Sham's retirement is 3.5 crores. Of course, keep in mind is we have assumed 12% returns on equity SIP. Keep in mind is there is no guarantee. Past track record is no guarantee for future. But yes, looking at the track record of some mutual funds, we have taken 12%. But yes, the learnings from this is Ram. The earlier you start, you make more money because Ram started with a small amount, but because of his longer time period, his money, he got the advantage of compounding. And that's where SIP comes into the picture, systematic investment plan. He was disciplined and he put in a habit. Same thing applies to Sham. Only difference is Sham started 10 years after Ram. Okay, so though he increased his amount and though he invested for a longer period, still he was not able to beat Ram. So this is how rupee cost averaging works in a mutual fund. So let's take, for example, market is rising. Obviously, the NAV rises. I told you NAV is the basket of stocks, their value. Of course, each of the stocks rises, so the NAV rises. You're taking lesser units. So what is the meaning of that? When the market is high, you're taking lesser units. So you're buying less. And when it's falling market, when the market is falling, you're buying more and more units. Okay, so let's look at average purchase. If the average purchase in falling rising market was 13.58, your cost is 12.92, which is much better than the average price. Same thing in the falling market, average NAV would have been 8 rupees, 8.04, but your price is 7.72, which is much lesser rate you've got it. So that's the beauty about it. Like, for example, if the market is choppy, up, down, up, down, up, down, then again, because of SIP, your average would have been 10.83, but now it is just 10.69. So that's the benefit. And this is just cost per unit. Of course, more the units, so significant that, small amount becomes a big amount over a period of time. So automated, once you ensure that your savings and investments are always greater than your expenses, and systematic investment plan to automate. These are the 7 habits of, you've heard about highly successful, highly effective people. So these are of highly effective investors. So spend less than you earn. And this knowledge is very important. I always hope that, whenever I spoke to Finzene, we have a discussion and we always feel that all this information, if we would have known during our early age, I mean, it would have been made a lot of difference. Okay. So start investing earlier. Yes. Make a system for investment, that is savings, investment and expenses. Proper allocation based on your goal, short-term goal, medium-term goal, long-term goal. Have a financial plan, emergency fund. It is always essential. Do not get overburdened by debt. A lot of time you get an SMS. Hey, you're eligible for a loan of 2 lakhs. You're eligible loan for 4 lakhs. Oh, do you want to take a vacation? Take a vacation, pay in installments. We've got this card, we've got a travel card, but don't go. Always maintain a good CIBIL score. CIBIL score is where, whenever you take a loan and your track record of repayment is tracked, and based on that, you get a score. So a better score, if you default, your score goes bad, lenders don't lend you or they may charge you a higher rate of interest. Okay, fine. And of course, your company may give you insurance, but always take a family floater plan. Family floater means you take a plan for your family. If somebody falls, anyone can fall sick, they can take benefit of that coverage. So yes, and of course, this is what, if you know, you can execute, that's definitely good. Otherwise, always go in and seek an advice of an expert, like an financial advisors are there, where they can do this goal setting and help you reach your financial objectives. BSE has also got, Bombay Stock Exchange has got a mutual fund distribution scheme. So there, if you see, the traditional was very much into physical, but now this is automated. Okay. Mutual funds are also a part of it, and you can do it on an automated process. There is no cost. You don't have to travel to an agent and all that. mutual fund, you can do it with the help of your advisor. He can help you to do it. And you can straight away invest in mutual fund via this Bombay Stock Exchange ka distribution fund, uh, distribution system. So it's a platform. So with this, we've come to an end. Just before I sum up telling you certain important points, I would like to know, in case if you have any questions, please do ask me. Of course, we have still some time, given the fact that we started a little late. There is a feedback link which my colleague has shared. You can just click on that and share your feedback. Ms. Sonali, if you wish to, you can share the link again, because I can see a lot of questions on the chat, so possibly it would have gone up. I leave it to you. Okay. So any questions so far? Otherwise, then I can just tell you some 2-3 points which would be a takeaways of this session.
It's a very hot topic a student has asked, G Rekha, that a great session. Can you share your thoughts about investing in cryptocurrency?
So now these are my personal thoughts. So I've seen a lot of big investors investing in Bitcoins, cryptocurrency. Okay, there are these top 2-3 where they've invested. My personal thought is, if there is nobody to regulate anything, then I somehow am not comfortable with those investments. Okay. Now a lot of thing works on fear of missing out. So a lot of my friends say, "Arey, Bitcoin, you start investing, you'll get 30%, 40%." Of course, it's tempting. But if I don't understand something, I don't put my money. So that's what it is. But and in Bitcoin also, since it's not regulated, at least in India, okay. So there have been some frauds. So there are some, Bitcoin is a good currency, Ethereum is a good currency, but that contains a very high element of risk. Okay, fine. So it doesn't come under my risk profile. But yes, if you have that risk, you can try that. Also, the government of India is working on something. So as of now in the budget, we were expecting something to come on cryptocurrency, but other than taxation, government has not spoken anything. Okay, fine. But it also means that government is also supporting cryptocurrency, though I won't say directly, but yes, fine. So yes, cryptocurrency comes with a lot of risk. Invest in the ones which are reputed, if at all. Okay, fine. So the ones which are reputed, some names which I can think about is there is this Ethereum, Matic, Bitcoin is one of them, and because I've seen there have been a lot of scams also as far as Bitcoin is concerned. So be cautious. Be cautious, because if it's your hard-earned money, if you can take that much element of risk, don't overboard. You can keep a small amount, but don't go overboard, at least as of now, till a regulator comes into the picture. Okay. Rekha, thank you so much. Your question is answered. In case if there are more, you can ask me. Thank you, Rekha. So let me share some 2-3 takeaways of this session before we conclude. So Ms. Sonali, I will just share those and then we can conclude. Okay.
Thank
So
you.
number one is, if you want to become rich, okay, I always quote this when I talk with Finzene, when I talk with Sonali, I always feel ki in school, I learned about vitamin A, B, C, D, E. But if somebody would have taught me about vitamin M, I would have been a different person at that point of time, taking the advantage of compounding. M stands for money. Okay, fine. Okay. Second thing is, if you want to be rich, if you want to create wealth, either you have your own business or invest in somebody's business. Okay, fine. Somebody cannot be anybody, but yes, you have a stock market wherein there are some 5,000 companies which are regulated. You may not know about the ratios, debt equity, what is the net worth, what is the cash flow, etc., etc. So that's where you can take help of an expert, a financial advisor. I too take the help of Finzene to help me in my decisions. So you can take that. Mutual fund is a good way by which you can start investing, because mutual fund also consists of expert. It's all about planning your goals. So you'll be having a short-term goal, medium-term goal, long-term goal. Accordingly, you can start investing. And most important, have a habit of investing. So a systematic investment plan is an automated thing wherein you say, okay, every month 1,000 rupees, 2,000 rupees, 4,000 rupees goes automatically, and you continue with your work. You don't have to get worried about the choppy market here and there. Clear? So with this, thank you so much. It was a great audience. I like the energy and the questions and your, of course, your answers to the questions which I asked you. Okay, so I thank Finzene team, I thank the CIL team and the management for giving us a permission to do this. So Sonali, you can take it forward now.
Yeah, thank you, sir, for such an insightful session. I definitely feel that student would have at least been sensitized that, how much it is important to save and grow their money. So thank you for taking us through this journey of financial awareness. And I would also like to thank Jitin because he had made it possible, to arrange this session for all of you. So yes, thank you everyone for being a part of this wonderful session. I have just dropped a note over here. So in case you need any help in further planning of your uh, if you need any help in starting your financial plan, so you can reach out to us, and you can also follow us on LinkedIn where we share a lot of updates on the capital market. So with this, I will just take a leave and thank you. Have a nice day.
Ma'am, just a minute, ma'am. Thank you, ma'am, and thank you, Johnson, sir. Ma'am, our representative will be giving the vote of thanks for the session.
Yeah.
So please wait for a few 1 or 2 minutes.
Definitely.
Good afternoon, everyone. My job is to thank. I thank Johnson sir for a wonderful session about the financial literacy, because financial literacy, the financial literacy knowledge is one of the hot topic now, because financial literacy is one of the things which every earning person should have a knowledge about, especially for an youngster like students who are in this step toward. So it is very important for us. So I thank Johnson sir for delivering a wonderful session. I thank Johnson sir on behalf of SOMS and Finance Club of SOMS. And also I thank Sonali ma'am for coordinating this session, and I also thank Finzene Group for approaching NIT Calicut for delivering a wonderful session. Also, I thank our HOD, Dr. Muhammad Shafi, and all the Finance Club members for conducting a wonderful session in this time. And I also thank all the students who have joined here. Thank you, everyone. Thank you for joining.
Thank you so much. Thank you.
Thanks, Krishna. Thank you. Have a wonderful day, everyone.
Thank you, ma'am. Thank you.